Hello, everybody. This is Alan Ellman, welcoming you to this BCI podcast number 131, titled Understanding the Math of Unwinding a Covered Call Writing Trade Early. We're going to be using a real-life example with Invesco Solar ETF, which trades on the New York Stock Exchange under the ticker symbol TAN. Let's start off by defining what is the mid-contract unwind exit strategy. This is one of our covered call writing exit strategies. We have an arsenal of these position management opportunities. And this is where we close both legs of the trade, the short call and the long stock, as the price of the stock accelerates substantially. Now, we use the Unwind Now tab of the Elite or Elite Plus calculators to determine the time value cost to close. And I'm underlining time value because the cost to close itself will be quite large because it'll have a large intrinsic value component, as you'll see in a moment. However, the time value component of these deep in the money strikes will be approaching zero. And that is the key to the mid-contract unwind exit strategy. Now we take this time value cost to close and we say to ourselves, if we close both legs of this now successful trade, can we generate an additional 1% more than that time value cost to close by contract expiration? In other words, can we set up a second income stream that will generate at least 1% or higher in addition to the original time value profit? All right, let's get back now to our real life example with TAN. And this trade was shared by a BCI member with me back in September of 2020. Here's how it goes. On 9/29/20, TAN was purchased at $61.95. Immediately after purchasing the shares, putting us in a covered or protected position, the $60 in the money call option with an expiration date of 10/16 was sold at 336. So the 60 call is in the money or lower than the current market value when the shares were purchased at $61.95. The premium, 336. Now, just a week later, keep in mind that we're talking about now about a 18-day return because the expiration date is 10/16 and the trade was entered 9/29. So about an 18-day return. Now, a week later, after entering this trade, TAN was trading at $71.15. It popped up over $9 a share. And the cost to close was $11.50. Now, that seems like a lot of money. However, of that $11.50, we have to take a look and see that that 60 call was in the money by $11.15. So of that $11.50, $11.15 was intrinsic value. We're going to get that back. If we remove that $60 call strike, our shares are now worth $71.15, not $60. So the actual time value cost to close is $11.50 minus $11.15 or 35 cents per share. And that is the crux of the success of this trade. Let's first have a look and see what the initial structuring looked like. Now, for those of you watching this podcast, on the left side of the screenshot are blue cells. That's where you make the trade entries. I'll just describe this for those of you who are just listening to this podcast. And we enter that TAN was trading at $61.95. The 60 strikes was sold at 336. The expiration date was 10/16. Now, automatically in the white cells on the right side of the spreadsheet, we see that the intrinsic value component of that option was $1.95. That's the amount the 60 strike was lower than current market value of $61.95. The break-even price point is always the price of the stock on trade entry. minus the entire option premium, both components, intrinsic and time value. And that in this case is 58.59. Now, the key components of this spreadsheet tells us that the return on our option, or ROO, highlighted in yellow for those watching, was 2.4%. Now, that's not the entire 336 premium. It's the 336 premium minus the intrinsic value. The spreadsheet will do that for us. We don't have to worry about the math. So the time value return, the initial 18-day time value return, is 2.4%. Now, we know there's no upside because we're agreeing to sell our shares at a lower price than they're currently trading for. But there is downside protection of 3.1%. Now, that's different than break even. That means we are guaranteed a 2.4% 18-day return as long as share value does not decline by more than 3.1% by expiration Friday. Or stated differently, as long as the shares do not decline from 61.95 to below the 60 strike by the expiration date. So it's looking like a pretty safe, good trade at that point in time. Now let's take a look and see the time value cost to close, because TAM went up so much from 61.95 to 71.15. Let's see what the time value cost to close is. So we first feed the information into the left side of the Unwind Now tab of the Elite or Elite Plus calculators. We put in that information that TAN is now trading at 71.15 and that the cost to close with the intrinsic value is 11.50. And the calculator will do all the heavy lifting for us and let us know, for those of you watching, on the bottom right of the screenshot, you will see that the cost to close is $35 per contract, and that represents a time value cost to close of 0.58%. So do we pull the trigger on this? Well, if we can find a trade that we like that will generate a minimum of 1.58% by the expiration date, then we pull the trigger on the mid-contract unwind exit strategy. Otherwise, we just continue to monitor the trade, which is quite successful at this point in time, and decide later on whether or not there are any exit strategy opportunities. If not, then we wait for expiration Friday and decide if we want to roll the in-the-money strike. Let's summarize. Exit strategy opportunities must be executed when it is beneficial. Not every situation requires an exit strategy. To make these determinations, the BCI calculators will assist us in giving us the math behind the trades, and then we can make determinations whether or not those stats align with our strategy goals and our personal risk tolerance. In this particular case, a successful trade was executed at that point in time, and establishing a second income stream with the same cash investment was definitely a possibility. So, ladies and gentlemen, there you have it. Before I leave, I just want to mention, as I always do, our best and most comprehensive investment package ever offered by the blue-collar investor. We call it the BCI Package, which consists of 18 components, 6 online video courses with downloadable workbooks, 6 calculators invented and created by the BCI team, and 5 of our best-selling books on covered call writing, selling cash secure puts, and their related strategies in ebook format, along with our 13-month annual premium membership, which has over 200 components to that particular subscription. Now, where do you get that? Go to our website, www.thebluecollarinvestor.com. Click on the link at the top that says BCI Package. Now, you can also get all of these items individually. Just go to our website, thebluecollarinvestor.com/store, and you will have our books, our video courses, our calculators, ebooks, and as well as our coaching program. Membership, there's a different link for that. And by the way, that last membership component consists also of over 200 training videos and we add one new one every month. So there's a huge educational component to the membership as well. Ladies and gentlemen, there we have it. Our BCI podcast number 131, Understanding the Math of Unwinding Covered Call Writing Trades Early. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.